Our next reading is fixed income market, issuance, trading, and funding. These are the learning outcome statements, I guess a total of 10. And these are the key areas in this reading. Type of issuers, debt security structures, features of various debt securities, and the difference between fixed rate and floating rate debt, and finally how the rates are determined. So these are the key areas in this reading. First, LOS. Describe classifications of global fixed income markets. This is how we can classify the fixed income markets with regard to type of issuers. We can classify with regard to the credit quality of the bonds, fixed income securities, with regard to maturities, with regard to coupon structure, with regard to currency, with regard to geography, with regard to indexing, and with regard to tax. So these are the classifications. First, with regard to issuers. Some securities are issued by the government, sovereign bonds, local governments. Some bonds are issued by corporations, financial corporations, non-financial corporations. So these could be the issuers. Bonds could also be classified with regard to credit quality. There are 3 top credit rating agencies in the world: Standard & Poor, Fitch, and Moody's. Big 3. The market for rating is dominated by these big 3 rating agencies. So bonds can be classified with regard to the credit quality, with regard to the probability of default. So as per Standard & Poor and Fitch, a bond that is rated as AAA, A, or BBB, such bonds are classified as investment grade bonds. Moody's have similar ratings. Moody's have rating of A, small, and then Baa3. These are investment grades, and those with BB plus, Ba1, so on. These we don't need to remember this specific symbols. How do they rate? Just that we need to know that the bonds could be rated this way. The investment grade bonds, and the second that have these rating as per Moody's, these are called speculative or junk bonds. That's the second classification. Then the third is bonds can be classified with regard to the maturities, original maturities, when the bonds were originally issued. If a bond or a fixed income security has a maturity of less than 1 year, such a security is called money market security, like US Treasury bills, commercial paper, negotiable certificate of deposit. We'll discuss these in our subsequent slides. Then the fixed income security that has original maturity of more than 1 year, such securities are called capital market securities. Capital market securities, your bonds with more than 1 year, are called the capital market securities. Then next classification, I don't know what this word is doing here. Then we have coupon structure. Fixed income securities can also be classified with regard to coupon structure. The coupon structure could be the floating rate, that is reference rate, plus a certain spread over above reference rate, or it could be a fixed income security. So coupon structure wise, either it could be a floating rate note or floating rate bond, or a fixed rate bond. Then the next classification could be the currency wise, whether the security is denominated in US dollars, euros, or any other currency. These are the 2 dominant currencies. These are the most widely used currencies for bond denomination. Then we have the classification with regard to geography, whether the bonds are domestic, as we discussed yesterday. A bond issued within Pakistan, registered in Pakistan, issued in Pakistan, we'll call it domestic bond. A bond issued by a Pakistani firm in India, denominated in Indian currency, issued in India, registered in India, and denominated in Indian currency, this will be called as a foreign currency note. Right? So domestic bond, foreign bond. We also discussed classification with regard to Euro bonds. Then whether the bonds have been issued in a developed economy like US, Canada, Germany, UK, or whether the bonds are from emerging markets. Right? So this could be the sixth classification. Then bonds could be classified with regard to whether it's an index bond. We discussed this yesterday in our previous slide, previous reading, index-linked bond, inflation-linked bond. And then bonds could be tax-free. Certain bonds in the US, they are exempt from the state tax, but the federal tax is to be paid. So whether the bonds are, the interest income of the bonds are tax-free, or are they taxable at the federal or the state level. So these are the classification of fixed income securities, and these are different aspects. Moving on to the next reading, next LOS. Describe the use of interbank offered rates as reference rates in floating rate debt. Most widely used reference rates are Libor, that is London Interbank Offered Rate. That's the most widely used. We have alternatives as well, Eurobond, but this is the most widely used reference rate. So Libor itself is not basically a single rate. It could be like, just like in any country, the rates are either quarterly policy rate issued by the central banks, could be biannually or yearly rates. Likewise, Libor is not a single rate, rather it's a set of rates. 30 days US dollar Libor, 90 days Swiss francs Libor. So it's basically a set of rates, right? So Libor, London Interbank Offered Rate, this is the rate at which banks lend to each other. It's called interbank money market rate. It's the rate at which banks will lend to each other. Now the problem is that a bank A may charge a rate of, let's say, 3% from bank B for an overnight loan. Another bank C within London, let's say, may charge a rate of 4% from bank D. Then how we determine what is the London Interbank Offered Rate in dollar Libor? So for this they have a mechanism. What they do, they take average of 18 banks, average calculated from a survey of 18 banks, and they exclude the lowest and the highest rate. Excluding the lowest and highest rate, the remaining 18 rates are averaged. That average rate is considered as a reference rate. So this is how Libor is determined. And as I said, Libor is not a single rate, it's a set of rates. Right? So it's a set of rate that is basically an average of 18 banks rate, that expected borrowing rates between these banks, 18 banks, excluding the lowest and the highest. Now the problem, as you might have been in touch with financial press, I would like to read this first. Regulators in the United States, the UK, and the European Union have fined banks more than $9 billion for rigging Libor. They have tried to rig Libor because banks may play with the rates. Just like wash sales in the stock market, where two traders, A and B, they trade between them certain shares at price so as to manipulate the market price. A will set a sell order of 500 shares at 50 each. At the same time, B will set a buy order of 500 shares at 50 each. Now in the next trade, B might set a sale of 500 shares at 55 each, and A will set a buy order at this. So this is called wash sales. Deliberately done. Of course, the regulator is watching. The stock market is watching. So this could be traced out, identified who is the broker, which trade is being done. It can be traced. There are many instances where the traders have been caught, the brokerage licenses have been cancelled. So this could be, this have happened here. The banks have manipulated the Libor, rigging Libor. So this was a watershed movement. So now they are planning to move away from Libor by the end of 2021. Replace Libor. They will focus on more market determined rates. So that is what can happen. So we have an alternative as well, but this is still the widely used reference rate. And this is how reference rates are determined through interbank money markets. The rates at which the bank lend to each other, we exclude the highest and lowest and take the average of 18 rates, and that serves as the Libor. And as I said, it's a set of rates, 30 days, 90 days, and up to 1 year. Then issues with Libor is that it is being manipulated by banks. Many banks have been fined $9 billion, a massive amount. Why? Because this Libor is a single reference rate that underpins over 300 trillion worth of loans worldwide. So a single, even 10 basis point manipulation could result in a massive swings in these assets under management, these debts. So that's why they needed an alternative. So alternative Libor is structured overnight financing rate. That is that's used in the US. This is the new rate, will likely to be structured overnight financing rate called SOFR. This is based upon the actual rates of repo transactions. Repo is one of the arrangements we'll see in our subsequent slides. So this is the alternative to Libor. Right now, what we need to learn here is that, let's say if I have issued a floating rate note, and the interest rate is reset after every 3 months. So for this, I will use 90 days Libor, because the rate is to be reset after 3 months. So the reference rate has to be 90 days Libor. Or if it's a 1 year floating rate, then the reference rate will be 12 months Libor, right? So this is the important point to be noted from this reading, this LOS. Moving on to the next LOS. Describe mechanism available for issuing bonds in primary market. Just like for stocks, the primary markets where the IPOs are issued, initial public offer. Similarly, primary markets are the markets where the newly issued bonds are sold to the investors, right? So when you say primary market, it means the market where originally newly issued bonds are sold, and it could be issued to general public, or it could be a private placement, just like in equity. Equity could be offered to IPO to every individual, general public, or it could be a private placement under Section 504. So role of investment bank in public issue. Investment bank plays a very important role in bringing the issue to the public. It will determine what are the funding needs, the firm that wants to issue the bonds, how the bond must be structured, coupon, maturity, then creating or drawing up indenture. We discussed this, called trust deed, containing the obligations and what the issuer is expected to do, what are the rights of the buyers, obligations of the issuers. So creating of indenture, naming the trustee in case of, we discussed, yes, trustee means a bank, or could be a company that will be an interparty. Like there are 3-party arrangement. One is the issuer that issued the bond, the other is the holder. So someone will has to play a middleman role that will ensure that the collateral is secure, is kept up to date in case of financial assets that have been used as a collateral to issue bonds. So those assets are transferred in the name of trustee. That is to be determined who is going to be the trustee, naming the bond trustee, who will be the trustee. And then once it is done, if it's a public issue cannot be made unless a registration statement has been filed with SEC. Just like a share issue requires approval from Securities and Exchange Commission. A public issue of bonds requires registration with the Securities and Exchange Commission, SEC. Right? Once it is done, then the investment banker will assess the demand of the bond and the pricing would be then determined, keeping in mind the market condition, and then finally selling the bond. So this is the role of investment bank. Will determine the funding needs, structuring, drawing up indenture, determining who trustee is going to be, filing for registration of the bonds, and then finally selling the bonds. Now, there are two arrangements with the investment bankers. Either it's going to be an underwriting offering in which all the bonds are bought by the underwriters, by the investment banks, and these investment banks then sell the bonds to the public. This is one arrangement where all the bonds are purchased by the investment bank and then investment bank will sell these bonds in the market. Or second option is the best effort offering, where investment banker for a commission agrees to sell the bonds and they will try to put their best effort to sell as many bonds as possible. All right. So if a bond issue is quite large in dollar denomination, then it will be difficult for a single investment bank to manage. So in this case, there might be a consortium of investment banks, which you call the underwriting syndicate, and then they can collectively undertake this process of bond issue, and one of them will serve as a lead underwriter that will lead the whole process. Right. Now, done. There is another way when a bond is about to be brought in the market. We publicize the bond. It's in the process of being brought to the market. So we publicize. We would like to see how the dealers would respond. According to their response, we might set suitable pricing. So this is we call gray market, where the bonds are not yet in issue, but we just like to assess how the dealers would price, how they react, how they will respond to our bond issue. So accordingly, it will help us to price the bond appropriately. And in some cases, even the bonds are not issued, yet it could be traded. Bonds are not in issue yet, but they are being traded on what you call when issued basis. When they will issue, then they will be settled. So this is a market which is not neither a black market nor a white one. It's somewhere in between, where the bonds are not really in existence, but the trading starts between the transacting parties. So they will settle the transactions when they are issued. So such market is called gray market. Then primary dealers, these are the individuals or firms who will purchase bonds from the federal government and then they will sell it. They'll, just like in stock markets, there is a dealer market and then there are broker markets. So dealer market and bonds as well. The dealers will purchase the bonds, the whole of it sometimes, and then they will sell these bonds based upon, they will set the bid and ask price, and accordingly they will make the market on these bonds. And the difference between the bid and ask, this would represent their income. Then next is shelf registration. In shelf registration, see, we just discussed that when a public issue is to be brought, it has to be registered with SEC. Every time when you issue a public shares or public bonds to public, it has to, because there is a public issue involved. General public's interest must be protected. So that's why SEC comes into action. So SEC must be intimated, must be registration statement must be filed in case of stock issue to the public, in case of bond issue to the public. If a company wants to issue bonds over a period of time, so instead of filing registration statement with the SEC again and again and again, a firm can file a shelf registration with the SEC. Once done and it's approved, then bonds can be issued over time. You don't have to file registration statement again and again. Once it is done, then the bonds could be issued in tranches out of that self-registration process. So, but this facility is only available to those firms that are financially sound. Right? So, only financially sound companies are granted this option, shelf registration, where registration is once filed with the SEC, and then bonds can be issued over time whenever the issuer needs money, maybe in the first year, then in the third year, then maybe in the seventh year, or maybe within 1 year. So it's entirely dependent upon the circumstances. So once it is granted by the SEC approved, then the bonds could be issued over time. All right, now your next LOS is describes secondary market for bonds. So previous it was the primary market where the bond is initially brought. Next is the secondary market. Secondary market is a market where the bonds will change hands once it has been issued. It will change hands amongst various investors. So secondary market refers to the trading of issues or trading of securities that have already been issued, just like your secondary market, stock market. Once the IPO is issued, then the subsequent trades between various investors, buy, sell, that takes place in the secondary market. So secondary market basically refers to trading of previously issued bonds. When the bonds are first time issued, they become in the primary market, and then the second hand trade between these different investors for these bonds is in the secondary market. So the secondary market, it is dealer driven market, just like in the primary market. Dealer will post bid and ask prices for the various bonds issued, and as I said, the difference between the dealer bid and ask price would represent the income for the dealer. The gap between the bid and ask for average bond could be 12 basis point, 10 to 12 basis point. That's for the liquid bond that has more liquidity, there are more transactions. But if the bond is relatively illiquid, the spread could be as high as 50 basis point for an illiquid issue. And of course, representing more gain for the dealer. Just like in stocks, in equities, when I buy a stock, the ownership will take some time to settle through settlement, clearing houses. Same is true for bonds. When I purchase a bond, it will take some time for the transaction to settle. In case of government bonds, it will take just 1 day max, or maybe the transaction is settled within the same day, right? But in case of corporate bonds, the settlement of transactions could take 2 days after transaction, maybe up to 3 days, or even longer. So this is happening all in the secondary market where the bonds have already been issued and they're just changing hands amongst different investors. Your next LOS is describes securities issued by sovereign governments. These we have discussed in our previous reading as well, but let's just have a quick overview. Sovereign bonds. Sovereign bonds are issued by national governments, treasuries, central banks. And as we discussed yesterday, they are backed by the taxing power. That is, the interest would be paid from the tax revenue of the federal government. These bonds have very or no default risk, hence they have high credit ratings. So let's say a US government can issue sovereign bonds in dollars, or these bonds can be denominated in currencies of different countries where they're issued. Then sovereign bonds issued in the foreign currency, yes, they will have low ratings than the local sovereign bonds. The bonds issued or denominated in dollar, they will have no risk, no default risk, they will high credit ratings. But if such sovereign bonds are issued in foreign currencies, let's say in pound sterling, so the ratings would be lower, low ratings. Why? Because the US government doesn't control printing of pound sterling. It doesn't control the money supply. It doesn't control the supply of pound sterling. So that's why sovereign bonds issued in foreign currencies, they will tend to have lower ratings than the local sovereign bonds, right? That's an important point to be remembered. And when the fresh issue comes in, sovereign bonds are risk-free, default risk is zero. Such bonds, they become a benchmark for other bonds, because the yield of other bonds are determined based upon these sovereign bonds. And fresh issues are called on-the-run bonds. All right, then interest rate on sovereign bonds, it could be fixed, it could be floating, or it could be inflation index bond. We discussed this in our previous reading. Then your next LOS, describe securities issued by non-sovereign government, quasi-government entities, and supranational agencies. Sovereign bonds are the bonds backed by taxing power issued by the national governments and the treasury. Then non-sovereign government bonds, they are government bonds, but they are non-sovereign, but because they are not backed by taxing authority. They are issued by the local governments, states in the US, provinces within the country, or counties. See, so they are governments. Yes, they are. They are governments, but the bonds are not backed by the taxing authority. They will pay the bonds out of this from specific projects, from some specific revenue stream of income. Still, since they are backed by the government, so they have high credit quality. Then non-sovereign bonds, non-sovereign government bonds, they tend to have yields higher than sovereign bonds. Why? Because of course, sovereign bonds, they are backed by taxing authority issued by the central treasuries, central banks. But comparatively, since they are low in rank than the central government, so since the risk is relatively higher, even they have high credit quality, yet since the risk is higher, so it must be compensated through higher yields. So yields is higher than the sovereign bond. Then next we have agency or quasi-government bonds. There are many state-sponsored enterprises like Federal National Mortgage Association. So such entities can issue bonds to raise funding. Such bonds are called agency bonds or quasi-government bonds. And of course, the rates or the yields on these bonds will be, let's say if here the rate is 3%, so you might find, let's say 5%. So the rate for agency quasi-government bonds would be higher than the sovereign and non-sovereign government bonds. Then supranational bonds, as we discussed in our yesterday's lecture, these are the bonds issued by supranational agencies that operate globally, which you call the multilateral agencies like World Bank, IMF, Asian Development Bank. So these bonds are very liquid and they have high credit quality. Of course, World Bank and IMF, they are the banks that save governments in trouble, just like a few years ago when Greece was in trouble. So there were 2 consecutive bailout packages. So IMF helps troubling governments. So as you can imagine, they are huge, massive. Your next LOS is describe types of debt issued by corporations. First is the bank debt. Many companies, they need money to run their day-to-day operations and of course for fixed capital expenditure. So bank debt, this is the most widely used source of finance for companies. Different types of loans are taken, which could be a term loan for a specific period of time, or it could be an self-amortizing loan where the regular payments will involve interest payment as well as principal part. So these loans could be Libor-based variable rates, or they could be fixed as well. Sometimes the loans could be so large that a single bank doesn't want to take this much exposure. Like let's say I need $100 million loan for my balancing, reconstruction and reorganization project. $100 million is a sizable amount. So single bank will not be willing to lend this much amount of money. So what can I do? I can either split this amount and take loans from different banks to add up to 100 million, which will be unlikely because since a single project, so a single amount could be arranged by a banking syndicate, a syndicated loan. Different banks, bank A, B, C, D, they can form a consortium, and then we can arrange a syndicated loan when the loan is sizable. So it could be a bilateral between me and my banker, or it could be a syndicated loan, 100 million. Now, these loans or other loans like these, they can be bundled up, and then further bonds could be issued on this loan portfolio. So the syndicated loan plus other loans, they can be securitized, and then further bonds could be issued to investors over this loan portfolio, discussed later. Then next, what we are studying, different types of debt issued by corporations. Commercial paper. Commercial paper are issued by those firms that have good credit standing, credit-worthy corporations. Large firms with good credit ratings, they issue short-term notes that could be from 1 day to 270 days. Mostly they are for 90 days. Such instruments are called commercial paper. In the US, commercial papers are issued on discount basis. Let's say I need $1 million for 6 months period. So this $1 million can be raised by issuing commercial paper on discount basis, which will help me raise $980,000. This is what I will receive after the issuance cost and all that. So the $20,000 represents the discount. So when the commercial paper matures, I will pay the full 1 million. So those who have invested, the difference between what they paid versus what they got represents, let's say, the full of amount, $20,000 as their interest income. So you issued a discount with matures up to 1 day, up to 90 days, a maximum of 270 days. Commercial papers are sometimes also referred to as, I didn't write it here maybe, it's also referred to as bridge financing, called bridge financing. Why? Because it could be used as an intermediate arrangement before a firm goes for a larger, longer term loan. Because commercial papers maturity is up to maximum 270 days. So it's basically a temporary source of finance before we go for a big fish, large funding for our business expansion, modernization, or any project we would like to have long-term funds for. So commercial paper could be rolled over. They can be rolled over, just like a loan that can be refinanced. Commercial paper can be rolled over as well. Like when I've issued a bond for 90 days, right? It could be rolled over when it's about to mature for next 90 days. The firm that issued commercial paper could also run into difficulties, because firms might find itself difficult to repay when it's about to mature. Let's say if it couldn't be rolled over, the firm might find it difficult to repay because the financial conditions may deteriorate for the firm itself. Or maybe there could be significant systemic financial distress where all the firms are affected. Like in 2008 financial crisis, subprime mortgage crisis, firms were run out of liquid resources, credit lines were dried up, and many good firms, they could have done well, because of liquidity crunch, they were in trouble. So in order to avoid this risk that if it couldn't be rolled over, then we need to make arrangements with our banker for specific assistance in the form of backup lines of credit. If we are unable to honor the commitment on the due date, then the bankers will come to assist and repay the debt on our behalf. All right, then corporate bonds. What we are studying, describe types of debt issued by corporations. So bank, commercial papers, corporate bonds. Corporate bonds we have discussed in our earlier readings as well. They could be fixed rate and floating. They could be secured against a certain collateral, could be unsecured, could be serial bond, or with the sinking fund provision. This is what we discussed in our previous reading. Sinking fund provision means that the bond is redeemed in tranches, or we set aside a certain amount of money every year so as to get a sizable fund available, so that could be utilized to redeem the bonds when they become matured. This is called sinking fund provision, right? Something similar to it is called serial bonds. Serial bond is a bond, let's say a bond with a denomination of $1,000. A serial bond is a bond that is redeemed in specific amounts at a stated date that has been mentioned in the indenture. Let's say $100 is redeemed in the first year. It's a 10 years bond, let's say. $50 redeemed in the second year. $130 principal redeemed in the third year. Then what is the difference between sinking fund provisions? Because sinking fund provision also means that the bond is redeemed in parts. What about the serial bond? Serial bonds are redeemed specifically as per the pattern given in the indenture. But sinking fund doesn't have a specific way of redeeming the bonds. That's the major difference. Then the last type of corporate bond here are terms and MTNs. MTNs refers to medium-term notes. What we are studying, different types of debts issued by corporations. So one of these is MTNs. So it stands for medium-term notes, but you must not confuse the word medium means that they are for medium term. They could be for just few months, could be as long as up to 100 years. So we must not confuse the term medium term note with the time. It's just the term that is used as MTN. So the maturity could be up to 100 years. So just like bonds, MTNs can also have a fixed rate or floating rate. And these MTNs are normally issued by financial institutions since they are in very large denominations. So buyers and sellers are basically financial institutions. That's the little difference. Next LOS is describe structured financial instruments. What is the structured financial instrument? There are 4 types of structured financial instrument discussed in this specific LOS. Capital protected instruments, yield enhancement instruments, participation instruments, and leveraged instruments. In fact, these instruments are hybrid instruments that contain partly a debt security plus a derivative. Since we haven't discussed derivative now, that's in your subsequent reading, so I am going to embed a very interesting video. I think that will be more entertaining and exciting and much more effective than what we can discuss about these specific instruments now. So I'm going to embed that video, and I hope that will give you an overview. Once we do the derivatives, then these ideas will be further enhanced.
Structured financial instruments represent a broad sector of financial instruments. This sector includes asset-backed securities and collateralized debt obligations, which we've briefly discussed earlier and will be discussing in detail in a later topic. Our focus here shall be on other types of structured financial instruments. They include capital protected instruments, yield enhancement instruments, participation instruments, and leveraged instruments. Let's get started. A common attribute of all structured financial instruments is that they repackage and redistribute risks. These instruments typically have customized structures that often combine a bond and at least one derivative. Derivatives are financial instruments that derive value from one or more underlying assets, such as equities, bonds, and commodities. As such, the risks and returns to an investor of a structured financial instrument are linked to the performance of the underlying asset. We'll be making references to a few derivatives in this lesson, so if you're not familiar with them, do refer to the course on derivatives. The CFA curriculum categorizes such structured financial instruments into 4 broad categories. The first category is capital protected instruments. Such an instrument offers a guarantee of a minimum value at maturity as well as some potential upside gain. For example, an issuer can promise to return 100% capital after 1 year plus a percentage of any gains on Apple stock over the year. How does the issuer achieve this? One simple way to structure such a security is to combine a zero-coupon bond with a call option on the underlying asset, which in this case is the Apple stock. So, as in this case, let's say the security is priced at $1,000. The investor places $1,000 at initiation and is promised that she will receive the $1,000 back at maturity, plus a percentage of any gains from Apple's stock. Let's say there's a risk-free zero-coupon bond with a face value of $1,000 that matures in 1 year, selling at a discounted price of $950. This constitutes the maximum return of $1,000 to the investor at maturity. The remaining $50 from the investor can be used to buy a call option on Apple's stock with a predetermined strike price. If Apple's stock price ends up below the strike price, the option will simply expire out of the money and there is no loss to the long call. If Apple's stock price ends above the strike price at maturity, the difference between the spot and the strike price is the gain that will form the potential upside to the investor. So now you see how easy it is to achieve capital protection by combining a zero-coupon bond with a call option. Such a structured financial instrument is called a guarantee certificate because the guaranteed payoff is equal to the initial cost of the structured security. This does not always have to be the case though. For instance, an issuer can reduce the capital protection level to 80% by putting less money in the zero-coupon bond. This allows the issuer to purchase more call options, thus multiplying the potential upside to the investor. Another category of structured financial instruments is yield enhancement instruments. Yield enhancement refers to increasing risk exposure in the hope of realizing a higher expected return. A credit-linked note is an example of a yield enhancement instrument. Purchasing a CLN can be viewed as buying a note, and simultaneously selling a derivative known as a credit default swap. Let's break down the payoffs from the two instruments. Firstly, a note by itself pays regular coupons and the return of principal at maturity. To enhance the yield of this note, the issuer takes the position of a CDS seller on some underlying asset. A CDS can be likened to an insurance contract against default of the underlying asset. As a seller, the issuer receives regular premiums from the buyer of the CDS. Such regular premiums can be used to top up the regular coupons to bump up the yield of the credit-linked note. At the expiration of the CDS, if the credit event did not occur, the issuer can redeem the CLN at par value. The issuer has successfully increased the yield of the note through selling the CDS. However, if by expiration the underlying asset did default, the credit event has occurred. The issuer, being the credit protection seller, will draw from the principal that is supposed to be returned to the CLN holders to pay to the CDS buyer. In such a case, the CLN holder may not receive the full par value back at maturity, and the attempt to increase the yield has failed. Let's move on to the third category of structured financial instruments. A participation instrument is one that allows investors to participate in the return of an underlying asset. A floating rate note can be viewed as a type of participation instrument. Its payoff can be viewed as a regular fixed coupon note combined with interest rate forwards. As we've learned earlier, the coupon rate of a floating rate note is usually calculated based on a spread, plus the reference rate, which is usually the Libor rate. The regular fixed coupons from the note provides the spread to the FRN. The returns from the Libor rate are captured by the interest rate forwards, thereby making adjustments to the regular coupons. This gives us floating rate coupons that participate in the movement of interest rates. A floating rate note has very little interest rate risk because changes in the cash flows limit the effect of changes in interest rates on its price. Besides this application of mitigating interest rate risks, participation instruments are also designed to give investors indirect exposure to a particular index or asset price. For example, a participation instrument can be structured to give investors an indirect exposure to US equity. You may be wondering, why gain indirect exposure when one could directly invest in the US market? Some fund managers may be restricted to invest only in debt securities, so having such instruments which are considered debt securities can give them the exposure that they desire from equity. And we conclude with the last category, leveraged instruments. Leverage instruments are very much like participation instruments. The coupon rate adjusts based on the performance of the underlying asset. However, in this case, the returns from the underlying can be magnified by a leverage factor. Leveraged instruments are created to magnify the returns of an underlying asset in order to offer the possibility of high payoffs from small investments. An inverse floater is an example of a leveraged instrument. In the case of an inverse floater, the leverage factor is a negative number. The cash flows move in the opposite direction of changes in the reference rate. So when the reference rate decreases, the coupon payment of an inverse floater increases. If the magnitude of the leverage factor is less than 1, the inverse floater is called a deleveraged inverse floater. The coupon payouts are less sensitive to changes in the reference rate. Conversely, if the magnitude of the leverage factor is greater than 1, the inverse floater is called a leveraged inverse floater. The coupon payouts are more sensitive to changes in the reference rate. And that concludes this lesson, where we are introduced to 4 classes of structured financial instruments other than asset-backed securities. Regardless of the classification, the payouts from a structured financial instrument can usually be decomposed to a combination of a bond and derivative.
Alright, so I hope that embedded video would have helped you in grasping the basic idea about these structured financial instruments. We will discuss these as we go along to our subsequent readings. So next we have describe short-term funding alternatives available to banks. These are the 4 short-term funding alternatives: customer deposits, certificate of deposit, excess reserve from central bank, fund market, and interbank funds. Customer deposits, also called the retail deposits, they are a short-term funding source for banks. So many account holders, checking account holders, they deposit their money with the bank. So this is one of the major sources of short-term funding available to banks. And of course, there is no interest to be paid on these deposits with the bank. Next, we have certificate of deposit. Banks often offer interest-bearing certificate of deposits that mature on specific dates, and they are offered in range of short-term maturities. There are 2 types of certificate of deposits. One is the negotiable certificate of deposit, which means they can be traded and they have a denomination of at least $1 million. It's also an important funding source for the bank, and its maturity is normally 1 or less than 1 year. But there are others called non-negotiable. These certificate deposits cannot be traded, cannot be sold, and withdrawal from the banks would entail certain penalty. Then in many countries, banks are required to maintain certain reserve with the central bank. So some banks might have excess reserve with the central bank, and some banks might have a shortfall in their reserves. So those with the excess reserve, they can sell their excess reserves to those with the shortfall in their reserve for periods as little as 1 day, overnight funds. So the rates applicable on these funds is called the central bank funds rate. Then there is interbank funds. That's the funds that are loaned by one bank to another. So they are called interbank funds. So interbank funds are loaned between banks for periods of 1 day to 1 year. And these loans are unsecured, and their availability is dependent upon the market conditions. If there is systemic financial distress, then liquidity may be severely decreased. So that completes this LOS. Next. Alright, your next LOS is describe repurchase agreements, repos, and the risks associated with them. What's a repurchase agreement called the repo agreements? It's an agreement by which one party sells a security to a counterparty with the commitment to buy it back at a later date at a specified higher price. Now let us see it from here. This is how a repo transaction works. A seller of government security brings his government securities as a collateral and sells it to the lender of money. He has sold these government securities for, let's say, $950,000. And lender has given him $950,000 cash funds. This agreement could be of 1 day, could be of 10 days, 15 days, 90 days. After the time at maturity, the one who sold his government securities or those specific financial assets to the lender of money will repay the original borrowed amount $950 plus interest, that's $980, and take the securities back. Government securities are returned. This transaction is called a repo transaction. This agreement where one party sells a security to a counterparty, lender of money, with a commitment to buy it back at a later date at a higher price, $980. Such an arrangement is called the repo agreement or repurchase agreement. Right? Now, since this is not done in a regular market, it's not a regulated transaction like the normal trade we have for bonds and for equity transactions, it's highly customized. There is no specific interest rate. This interest rate has to be implied. We will do it with the help of an example. It could be, this repo agreement could be for a single day called the overnight repo, and it could be a longer term called the term repo. Now, how do we determine what is the rate in this transaction? Let's take some numbers to explain the idea. Let's say the seller who has sold his government security had a par value of $1 million. Right? Currently, these government securities has a market value of $970,000. Right? The seller sold these securities at $940. Right? With an agreed amount that he will buy these securities back at an amount of $947,050. I'm using the numbers that are given in your notes so that you can relate these numbers. How did I do the computations? So, securities with a par value of $1 million, fair value or the market value $970,000 were sold for $940 with an agreed amount that they will be purchased at $947,050. The difference between the loan amount versus what will be repaid, this difference, $7,050. This is the interest being paid, and this is what percentage you can divide $7,050 divided by the loan amount. It will be approximately 0.75%. Right? It's, let's say, a 90-day repo transaction. Then you can, of course, annualize it by dividing it with 90 and multiplying with 360. So right now it's points. This is called the implied rate of interest because interest rate was not explicitly mentioned in this repo transaction. So we had to use the numbers to drive the implied interest rate. So it's 0.75 per quarter, which could be given an annual form by multiplying with 360 dividing by 90. So that's how the repo transactions are done. One party bring in the government securities or any collateral for the loan. Basically, it's a collateralized loan. Technically speaking, this repo agreement is a collateralized loan where the seller has given the collateral, took the loan money, and after some time he gave the loan amount back with interest. So it's effectively it's a collateralized loan. Okay, now there are certain important terms. Repo date, the time in the repo agreement when this transaction was entered into. There are other important things that we must discuss here. We have discussed the implied interest rate. We also need to discuss the repo margin. What's the repo margin? Let's say if I have a $1 million worth of property. I give this property's documents to the bank for loan. Bank will not grant me loan for $1 million. Bank will give me a loan, something 70% of the market price, maybe $750,000. Something similar has happened here as well. The market value of these securities is $970,000. Par is $1 million. Par is irrelevant because this is the current market price. But the loan amount given to me was $940. The difference 30,000 different. This difference 30,000. This difference represents the repo margin. This difference represents the repo margin. In this arrangement, it's about 3.1%. It's also called the haircut. Why? Because I have received 940,000, giving 970,000 worth of securities to the lender. What if the price of these securities fall? So lender will have a cushion of 3.1%. The securities prices can fall, but it won't fall below 3.1. So this cushion, this margin, the lender must have as a protection in case if these collateral fall in value, right? So that's an important point. This is called the repo margin or haircut, right? So what is it? I think we have already calculated the percentage difference between the market value and the amount loaned. This is the amount loaned. This is the market value. So the difference, percentage difference between these two is called the repo margin or haircut, and it provides protection to the lender who has provided these funds as a loan. Now, there are certain important terms that you need to be aware of. Factors affecting the repo rate. Now, here the rate we calculated was, let's say, 0.75%. Factors affecting the repo rate, that is the implied rate. What are the factors that affect this rate? Let us discuss these one by one. If the term of the repo agreement is longer, here it was 90 days repo, right? What if the term is 270 days? Longer the term, higher would be the implied rate. This is even for the quarter. Let's say if it's on annualized basis, let's say it's 3%, right? For 90 days, it's 3% APR, annual percentage rate. If the term is 270, the rate would be higher. So higher the term, higher would be the repo rate. Shorter the term, lower would be the repo rate. Important point. Next, credit quality of the collateral. If the quality of the collateral is good, the securities are highly liquid with stable market prices, so in that case the repo rate would be low. And in case if the credit quality of the collateral is low, then the implied interest rate would be higher. If the securities have been delivered to the lender, the securities have been given to the lender, if that is true, then the repo rate would be lower. But if these securities have been given to some trustee, not the lender of the money, some third party, since the lender doesn't hold the securities, so in that case the interest would be higher. So if the delivery is to the lender, rate would be lower. If the delivery is not to the lender, then the rate could be higher. Then alternate interest rates. If alternate interest rates are higher, lender of the money will also charge higher implied interest rate. So this is how the repo rate is influenced by these factors. Now the next factor also, factors affecting the repo margin. What's the repo margin? We received $940,000 for the securities that had a market price of $970,000. The difference was 3.1%. That's the repo margin. Repo margin is affected by these, influenced by these 4-5 elements. The term. Longer the term of the repo agreement, then there is a more probability that there would be price fluctuations. So in that case, larger would be the repo margin, right? If the credit quality of the collateral is high, the repo margin would be low, and vice versa. Credit quality of the borrower is good, the repo margin would be low. If the collateral security is high in demand, highly demanded, highly liquid security, the repo margin would be lower. Collateral security is very limited in supply. The collateral, in that case, repo margin will be again low. Limited supply and more demand would mean that you would charge low margin for that security. And finally, reverse repo agreement, what is it? If we twist these arrangements, we have discussed this repurchase from the point of view of seller, that I'm going to give these securities to you as a collateral, give me the loan, I will repurchase this from you. If we talk about this agreement from the lender point of view, then the whole things are reversed, and then in that case it is called the reverse repo agreement. What we have discussed so far was from the point of view of seller, repurchase. where the seller will repurchase the securities. And if you see from the lender's point of view, it is called the reverse repo agreement, and that ends your Alvarez